Hi, welcome to the first mini lecture for Chapter 10, and Chapter 10 deals with liabilities, both current and long-term, so it's a pretty big chapter. The first couple of mini lectures are going to be dealing with just current liabilities, but let's do a little bit of a refresher on what liabilities are. Liabilities, if you remember from Chapter 1, are debts or obligations. We use the word debt because we know that we have to pay for liabilities in the future. And we use the word obligations when we refer to when the company gets paid ahead of time before they do any work, they have the obligation to do the work or deliver the goods at a future point in time. So liabilities are created primarily when a company buys goods and services on credit or when they obtain short-term loans to cover gaps in cash flows, or when they issue long-term debt to obtain money for expanding into new regions and markets. There's going to be other examples as well, which we'll talk about in a few moments. It says to help financial statement users know when liabilities must be repaid, the company prepares a classified balance sheet, which means we're going to break our liabilities into current or long-term. Current liabilities, and we learned this back in Chapter 2, are short-term obligations that will be paid or fulfilled within 1 year or less, and long-term liabilities, more than 1 year. Okay. With regard to measuring liabilities, they say that the amount reported for each liability is the result of three factors: the initial amount of the liability, additional amounts owed by the creditor, and then payment or services provided by the creditor. Okay, so let's just kind of review our accounting equation and how we record liabilities. The rules of debit or credit are based on the accounting equation itself. Assets are on the left side of the accounting equation, so we increase on the left or the debit side. Liabilities and stockholders' equity are on the right side of that equation, so we increase on the right or the credit side. To decrease, we do the opposite. So if we're focusing now on just liabilities, the rule for liabilities that we increase on the right or credit side and decrease on the left or debit side. So let's just take an example. Let's use accounts payable. Accounts payable is increased when the company purchases goods or services on credit, and it's decreased when the company pays on its account. And accounts payable is usually interest-free unless it becomes overdue, and then the company would have to pay financing charges. So let's use an example of buying supplies on credit. Supplies is an asset. If we want to increase that, we'll debit supplies. And let's use, that means it's going to increase that asset. Let's use the amount of $1,000 in supplies. If the supplies are purchased on account, which means on credit, we'll want to increase the liability account, accounts payable. Which means we owe that amount of money and we're going to pay it in the future. Accounts receivable is when we're going to receive money in the future. If we have to pay it in the future, it's accounts payable. So that would be our journal entry to show supplies purchased on account. When it came time to pay for those supplies, we would do the opposite. We'd want to decrease the liability, accounts payable, so we would debit accounts payable. And since we're paying for it, we will credit cash, and cash is an asset, so we'll decrease assets by crediting. So that's just a brief review of how to handle liabilities from a debit and credit standpoint. And it's also a bit of a review of what we learned about accounts payable in Chapter 2. Accrued liabilities we learned about in Chapter 4. That's any expenses that are unpaid, which a company has to accrue or record. We would increase by debiting the expense account and increase the liability account by crediting. What we have not talked about yet are payroll liabilities, and if you have had a job, then you're familiar with them. Payroll taxes. So what I'm going to do is, before we talk about these liabilities, let's take a look at what a paycheck looks like. I'm going to be going to your textbook for this, and I'm going to pull out page 448. And let me zoom in on this. Okay, so we have a picture here of a paycheck for Adam Palmer. And by the way, when you get paid by your employers, they have to show you what your payroll deductions and your gross pay computations are. Adam works for General Mills, so that's the issuing company. This paycheck was issued November 10th, 2018, and they'll show you the amount both in numbers and in words. And here's the payee. Often we have our paychecks directly deposited into our accounts, whether they're savings or checking. That amount, $483.20, is sometimes called the net pay or the take-home pay, because that's the amount you're actually going to get or deposit it into your account. And at the bottom here, we see the calculation. And I apologize, there may be a bit of a reflection or glare there. I'm going to try and hold this up a bit to reduce the glare. Here we go. So Adam worked 40 hours. His hourly pay rate is $15 an hour, so we multiply the two to calculate his gross pay. So Adam is an hourly or wage worker. In order to calculate their pay, we would multiply hours times hourly rate. If Adam worked more than 40 hours, he would be eligible for overtime. And New York state law and federal law is that your hourly rate is 1.5 times your overtime rate is 1.5 times your hourly rate. So 1.5 times 15 would be another $7.50 or $22.50. So if Adam worked any overtime hours, we would take the overtime hours times $22.50, and that would be added on to the gross pay. The gross pay is the amount you're going to debit to salaries and wages expense. From the gross pay, you have withheld federal income tax and state income tax, if the state you live in has a state income tax, and in New York we certainly do. FICA tax, which is Federal Insurance Contributions Act, and that includes both Social Security and Medicare. And then any voluntary deductions. Now, federal income tax, as well as state income tax, if the state you live in has income tax, and FICA tax are called mandatory or statutory withholdings or deductions. Both words are correct. That means your employer has no choice. They have to withhold those from your pay and then submit them to the appropriate government, whether it's state or federal. There may be, however, other deductions that you authorize, perhaps for union dues, or for a savings plan, or a retirement plan, or for health benefits. All those deductions are subtracted from gross pay. The total of the deductions here is $116.80. We would deduct that from the gross pay to get to your net pay, and that would be the credit to cash or salaries and wages payable if it's not going to be paid immediately. Each one of those deductions will have its own payable or liability account. So our journal entry is going to be to debit salaries and wages expense for the gross amount, to credit each one of the payables for the deductions, and then to credit the amount of net paid, either cash or salaries and wages payable. Now, there are other ways of paying people. The hourly rate or wage method is not the only way, but it's the most common way we use for employees who are not in administrative positions. If a person is in an administrative position, then they would receive a salary, which would be based on a monthly rate or weekly rate, and they would not be eligible for overtime. They're considered exempt from the Federal Labor Standards Act. You might hear the term exempt employee. So if they work less than 40 hours, their pay will not get docked. And if they work more than 40 hours, they are not eligible for overtime. And again, we are talking about salaried workers in that case. Folks can also work on a commissions basis. Real estate agents, folks who work for car dealerships often work on commission, but most times they're given a base salary and then they earn commission on top of that. Okay, let's take a look at the journal entry to issue the payroll. Okay, so if we had 1,000 employees just like Adam Palmer, then we would debit salaries and wages expense for the gross pay. We would set up a liability for each of the deductions. Here's withheld income tax payable. The reason why we don't say income tax payable is the company has to pay income tax, and we want to differentiate the employees from the company's income tax liability. So we would credit withheld income tax payable for the total deducted from our employees' pay for federal income tax. We would do the same if there was a state income tax. And then for FICA, both Social Security and Medicare, we would show a credit for the deduction amount withheld for that, and then a credit for any voluntary deductions, in this case, a charitable contribution. So these are the total of the three deductions from the gross pay, and the net pay, which is a credit to cash or salaries and wages payable, would be $483,200. Let's go back to our notes for a moment. A little bit more detail here on the deductions. So withheld income tax payable includes income tax withheld from the employee's pay. FICA payable stands for FICA, or Federal Insurance Contributions Act payable. There's two parts to FICA. There's 6.2, and that is Social Security. And then 1.45, and that's the Medicare portion. Added together, it's 7.65 that the employee has withheld from their pay. Now, once the employee earns $137,700 in 2020, there's no more Social Security deducted from their pay. However, the Medicare deduction continues. Now, with regard to FICA, whatever is deducted from the employee's pay, the employer also has to kick in or pay as well. So the employer matches the employee's contribution dollar for dollar. United Way Payable represents, in our example, any voluntary withholding. And as I mentioned, that could be for health benefits, it could be for union dues or a charitable contribution, whatever the employee chooses to have deducted. It could be nothing. Now, the second part of this whole calculation is the employer's payroll taxes. These were all employee deductions. Down here, we're talking about the employer's payroll taxes. So I'm going to highlight those to keep them separate. It's the employee's portion. This is the employer's portion. We said that the employer has to match dollar for dollar whatever is withheld from the employee's pay for FICA. And the employer also has to pay unemployment tax to both the federal and the state government. I'm just going to put here statutory, so you remember these are required or statutory, and these are voluntary. Okay, so let's take a look at a problem. If you have not yet printed out your worksheet, then please stop the video and print out the worksheet, because next we're going to be working on E10-3. And then you can come back and work on it. We can work on it together. Okay, now this is similar to problems M10-3 and M10-4 as well. Okay, McCloyd Company completed the salaries and wages payroll for March. The payroll provided the following details. We've got salaries and wages that were earned. They're referring to the gross pay here before deductions. And then here we've got two deductions. The employee income tax is withheld from their pay, and then FICA tax is withheld from employees' pay. And these are two deductions. Finally, they tell us about the amount of unemployment taxes the company had to pay. Make this a little bigger for us. There we go. In number 1, it says, considering both employee and employer payroll taxes, using the preceding information to calculate the total labor cost. Well, let's hold on that. Let's do number 1 down here after we do the journal entry, because I think it's easier to do the journal entry first. So we said, based on page 449, what we learned about on page 449, let's do the journal entry for payroll. Okay, and this is the end of March, so let's date this March 31st. We're going to debit the expense account called salaries and wages expense for the gross pay of $400,000. We're going to credit the two deductions, and we're going to put the word payable basically next to each of the deductions. We'll credit withheld income tax payable, which is a liability, for $37,000, and we'll credit FICA payable, also a liability to increase it, for $28,600. Now we're going to credit cash for the net pay. I'm going to put the words net pay here so that we know what we're talking about. And I'm going to show you the calculation as well. The net pay is going to be $400,000, which is the gross pay, minus the two deductions, minus $37,000, minus $28,600, or $334,400. Now let's record the employer's payment of their unemployment taxes, FICA and unemployment. So also on March 31st, we're going to record the employer's portion. Let's take a look at that journal entry also on page 449. The employer has to match the employee's withholding. So the employee had withheld $45,900. So the employer has to match that dollar for dollar. The employer also has to pay federal and state unemployment taxes. So if we add those two together, that's the total payroll tax expense. So we're going to do the same. going to debit payroll tax expense. And the way we figure that amount out is to add the two credits up. FICA payable, which is the same that was withheld from the employee, $28,006. And also we would debit unemployment taxes payable. And that would be both federal and state. If you want, you can set up two separate accounts, one for federal, one for state. That's $2,780. And to find out what the payroll tax expense is, we're going to add those two credits together. $28,600 plus $2,780. That will equal $31,380. So the total labor cost will be the addition of the two expense accounts. $400,000 for the salaries and wages expense and $31,380 for the payroll tax expense, or $431,380. So I'm going to stop there, and our next mini lecture will deal with notes payable.